Well, thank you so much for attending. This is a workshop that I've been wanting to put together for quite some time. It's the beginning of my first in a series. So far, I have 10 classes set up to help people become home buyers. And if you want more information and you can't wait until the next class, I'm happy to help you with that. Let's see here. Sorry, and it is my first class, so it might be a little wonky. So these workshops, I'm going to try to keep them at an hour long at the most, with questions and answers at the end. So please feel free to put them in chat. At the end, you're going to get an online dashboard, which will be updated throughout the series of classes with optional homework. So please RSVP for each homework, and you can do that at mortgageporter.com, and you'll see at the top of the page the assignments or the class link to sign up that says workshops. And it's okay if you are months away, or even it's going to be sometime next year, even longer, with your home buying journey. It just, the sooner you start, the better, just so you can learn as much as you can about the process, which will make it easier for you once you do find your next home. So a bit about me. I began in the title insurance escrow industry in 1986. That's me when I started as a title rep in the photo down there. And I became a loan officer in 2000 at Mortgage Master Service Corporation. I've been teaching homebuyer classes since 2014. A lot of them were for the state, and they were typically like 5 hours long on a hot library with no air conditioning on a weekend. And I always thought it'd be so much nicer if you could break these down into 1 hour chunks and really dig a little bit deeper into the topics. So I joined New American Funding 3 years ago. I write a nationally recognized blog, The Mortgage Porter, and I am a mom. I got 3 grown kids and a wife. And my favorite thing, though, really about my job is, I think, education and helping people understand the process, answering questions that they may have so that they can make an informed decision, whether they decide to buy a home or not buy a home. So, and I grew up mostly in South King County around the Renton-Kent area, and mostly renting. In fact, always renting. My parents did not own a home while I lived with them. I'm thankful that we had a home. I don't think there's anything wrong with renting, but as I look back, and especially as a mortgage advisor, I know that they missed out at on a lot of opportunities to have financial stability and create wealth. And so this is a picture of my first home. We bought it in 19, I was gonna say 1969. My numbers are throwing me off. Sorry about that. We bought it in like 1989 and paid about 69,000 for it. And we sold it like just a year later for 90. And I kind of started thinking that every time we bought a home, we were going to make like just huge profits on it. And it didn't always happen that way for us, but we did pretty good with this one. It's now worth about 470. And I bought it because we were renting an apartment in Kent, and a realtor left a flyer on my car that said, if you're paying this much in rent, you can afford a home. And I couldn't believe it, but I didn't want to rent anymore. And so I was just absolutely motivated to go find a house and buy it. So it was only 1,000 square feet. It had dark brown shag carpets, and one of the bedrooms was Pepto-Bismol pink. I mean, it was not really what I thought we would have, but we did little improvements over time during that short time that we owned it, and did well when we went to sell it. It took me well over an hour each way to get there to work, but I was always happy once I got home and had my own place. So, and when we did sell this home, by the way, it's what gave us our down payment for the next home that we bought, which was bigger and a little bit closer to work. And so location is, really important. It's something you'll hear real estate agents say all the time. It's all about location. And it's true. So if you are looking like in the Seattle area, and if affordability is a concern for you, you might want to consider other areas. And this is a topic that I think is more geared towards one that you should have with your real estate agent, as far as what locations might be best for you. But it's just really something I think to keep in mind. So this is a home that I helped a first-time home buyer purchase with their financing, and they just bought it in 2024. They paid 540,000 for it. It's now worth about 570, and it is in the Tumwater, Olympia area. And so they did go a little bit further out. The appreciation right now is estimated roughly at 30,000, and then the amortization, meaning the amount that they've paid down their mortgage balance, is a $6,000 gain. And so they've gained or added 36,000 in 1.5 years to their financial benefit. And so this doesn't include any potential tax benefits either. So it's really, it's something that this person would not have benefited from had she continued renting. So she's done really well. I just looked up this one the other day and for preparing for this class, and I was really surprised. It was a condo in Federal Way, just purchased in February this year, and they paid 353. It's now valued at around 371. So in just 9 months, they have an 18,000 appreciation gain. Haven't paid that much down on the mortgage. It does take a while to do, so only about 1,400, but that still is 19,000, plus approximate benefit from owning a home instead of paying rent. So, and one thing too is that a condo can be a really good option for somebody if they are looking at trying to find something more affordable as well, because they do tend to be priced lower than a detached home. So basic qualifications, and you'll see as I go over these that there's a lot of wiggle room with them. So 2 years of steady employment history is something that lenders like to see. As long as it's in the same line of work, your formal education may count that, and lenders will try to connect if you have several jobs, connect them together as well. If you've had gaps in employment, we might need to explain that. Income and assets that can be documented are ideal. So keeping your pay stubs and your W-2s are important. But we have programs available if your income isn't easily documented, or if you have to be creative with that, if you're self-employed, for example. Debt to income ratios, I'm going to go into all these things in future classes. This is just a real high overview, which is your calculating your debts to your gross income. Ideally before 45%, but we can go higher, especially with FHA loans, can go a lot higher for that ratio. And 3 established credit lines is also ideal, having them being 1 to 2 years, but not required necessarily. Credit scores of 620 or higher. And, with FHA, again, we can go a lot lower with a credit score. Savings for a down payment and enough savings for 2 months mortgage payments for reserves is really nice to have, but again, not required. The 2 months reserves is my personal wish for you, so you do have a little bit of cushion. So it's not required by underwriting on most programs. And the savings for down payment could be down payment assistance, or it doesn't have to be very much funds typically. It just depends on what your situation is and what mortgage programs are available for you. I hope I'm not going too fast. um, So when I do classes, I like to talk about the 4 C's of mortgage, and I think a chair is a really good analogy because on what an underwriter looks like for getting approved for a loan, because there's 4 basically legs to the transaction, and one chair leg can be a little weaker, and it's okay. The chair is still a good chair, but once you start to get 2 or 3 legs that are weak, it could make it a little bit more challenging to put that loan together. So the legs that we look at are capacity, which is the ability to repay your mortgage. So that is your income and your employment history and your debts. The credit is your credit history and credit scores. And again, like, what is your payment history? Capital is what your available assets are. So if you have a lot of extra reserves, even if you're not using them for the transaction, that's something that helps add strength to your file. Collateral is the new home. That's also very much a factor that underwriters look at when you go to purchase your home. And if you're not quite ready yet, that's okay. That is just means that we need to create a game plan for you and a strategy so that once we get things in line, whether it be your credit or employment or savings, then you're ready to buy a home. So it's just, I like to say it's not a no, it's just not yet. So what are some reasons somebody would opt to rent a home instead of buying? I think there's several good reasons to rent a home, and some of them may be that you have a job where you're going to be transferred, so you're not planning on staying in the area for long, or maybe you want to get to know a neighborhood better, or you have some credit issues. Some people feel that there's lower upfront cost with renting, and also may have a lack of funds for down payment and closing costs, or you want the landlord to take care of the maintenance that's involved with owning a home. And there is less commitment to owning a home, or to renting than owning a home. And again, if now is not the time and it's a few years before you're ready to make a move, we can always start by creating a game plan and take your time with the process. So why buy a home? Obviously, I'm biased on people to to buy a home, but I do understand that everybody has their reasons on why they should buy or continue renting. But buying a home, the biggest reasons is that for me is that equity. You have the opportunity to build equity over time, and that is, you're putting your mortgage payments to work for you, and your home is ideally gaining equity while you're just making your monthly payments, which you would be doing if you're renting too. But when you own, you get the benefit of that. So your mortgage payments and appreciation help work for you in creating financial security. There's also profit. So if you go to sell your home, just like I did with the homes that I've had in the past, you do get to take that profit with you. So, which is really how a lot of people get their down payments for their next home is from their starter home. There are also a lot of significant tax benefits with owning a home that you can take advantage of, such as writing off your mortgage interest, your property taxes, and other things. Another thing that's important is upgrades. You can make changes to your home. So I could paint my Pepto-Bismol room pink and get rid of that shag brown carpet, which I don't know, maybe that's back in style now. I don't know. So, but you have that ability, and also the ability to have pets, without having to run it by your landlord. And investment, it just gives you options. So with your home, if you don't sell it, you can always convert it to a rental down the road and have a rental property, or keep it and one day, pass it down to your family. So another thing too, just to illustrate, when you are paying rent, the money that you pay, it's just going to the landlord. So it's not benefiting you at all unless you're doing some sort of a rent to own kind of agreement. So this could be a mortgage payment instead that is going towards your benefit for the future when you make your mortgage payment. This quote is from Lawrence Yun, and he's the chief economist for the National Association of Realtors. And in the last 5 years, the average homeowner gained $140,900 in equity. And yet this doesn't happen overnight. It took 5 years for that to happen. And so you shouldn't expect a huge return right away, but it is a great way to build financial security. The average homeowner's net worth is said to be 43 times higher than that of someone who rents, based on the estimate for 2025 from the Federal Reserve Study of Consumer Finance and the National Association of Realtors. So, I mean, homeownership builds significant long-term wealth, and it is a strategy towards securing your financial future. And so we're going to get a little bit into taxes. I'm not going to dive too deep into that. That is really somewhere where you need to be talking with your tax advisor, and my specialty is helping you with your mortgage plan. So, but owning a home does come with several tax benefits that can significantly impact your financial situation. And some key advantages are, as I mentioned, the mortgage interest deduction. And that benefit allows you to deduct the interest that you pay from your taxable income. And that is really a significant savings if you look at your tax bracket that you may be in. And this is simplified. And these things change all the time too, which makes it even more fun to try to discuss it. But it does really help offset your mortgage payment. And I'll show that on the next screen. The property tax deduction allows you to deduct the taxes that you pay on your primary residence. And this deduction can also help reduce your overall tax liability, which also contributes to help making your home ownership more affordable. And now your private mortgage insurance, if you happen to have it, if you're putting less than 20% down, is also now a deduction to help offset your mortgage payment. So in order to get this benefit, you do need to itemize instead of taking the standard deduction. And so that is, again, something to talk with your CPA or tax advisor about. So when you know what tax bracket you're in, you can estimate what your tax benefit from having a mortgage may be, and every scenario is going to be different as far as what your tax benefit may be of owning a home. And so the estimates on this page that I didn't factor in property taxes or mortgage insurance. I'm really just giving a very basic idea to illustrate what your tax savings could be when you get a mortgage. I think it's something very important to keep in mind if you've not had that benefit before. And by the way, if you are getting a large refund from Uncle Sam every year, then it's probably time to look at your withholdings and maybe making an adjustment there, because you're just giving him an interest-free loan, and that'd be a lot better to have that money in your pocket. So I say for every 100,000 borrowed, you pay about just under $6,000 in interest in the first 12 months of the mortgage. And that's based off of an interest rate of 6.125, which is roughly where rates have been hanging around lately. So for a 30-year. So on a $500,000 loan, that is about 30,000 in interest, and you would times that times your tax bracket to come up with your tax benefit. And you can see on the, as your loan amount goes up, of course, that's a more of a tax benefit for you. And so again, sticking with the $500,000 loan, if let's say your tax bracket is 20%, that would get you a benefit of roughly $5,985, which comes down to monthly just under $500 a month. So, if your if your mortgage payment or principal interest portion of that would be, $3,038, you can basically factor in that your actual effective payment is closer to, $2,500 or $2,800. Excuse me, my math is being bad. I need my calculator. $2,800. So, and again, not factoring in any mortgage insurance or property taxes. I'm leaving the taxes to the CPA. So the other huge benefit is home appreciation and amortization. And home values tend to rise over time. They don't always. We've had some years where they take a little dip. But every time you make a mortgage payment, you are lowering your mortgage balance, unless you have an interest-only loan, which we'll talk about that down the road in a future class as well. But making your mortgage payments creates home equity that you can tap into later if you refinance or get a home equity loan, or when you go to sell the home. So, and again, the equity that you get from your first home is typically going to go towards buying your next home. And so here's another past client of mine. They did down payment assistance and really just got into this home with their $2,500 earnest money back in 2019. We refinanced it in between when they bought it, when they sold, but they sold it in 2023 for $560,000 with $185,000 gain in appreciation. And of course, there's some cost that go into selling the home, and I'm not also factoring in their payments over time, but still, this is a great return for their $2,500 investment of what they put into this home. And so I like to ask people if they think that home prices will go up or down over the next few years. It's really hard to say. There's no guarantee. I've been doing this for a long time, but the forecast, and of course, no guarantees with forecast. For King County, for a $600,000 home in 5 years, that the value would be close to $755,000, and so that's $155,000 appreciation forecasted in 5 years. And this chart is from the Case-Shiller Index, and it shows that over the past 83 years, homes nationally have appreciated all but 6 years. And so the biggest decline we see here is from 2007 to 2011. And that was from an era known as the mortgage meltdown. And it was when we had subprime mortgages and underwriting guidelines that are no longer available because of what happened during this time period. And so loans are being made to people that basically had no legs on their chair. If you remember my earlier analogy, like it was 100% financing with not a lot of requirements to get into homes. And so I did lose some clients during that time because there were programs that we wouldn't offer because they were too risky. So yeah, so overall, though, you can see that there is various forms of appreciation since back to 1942. Another question that comes up to me often when I'm meeting with clients is what about your home values during a recession? And so these light gray areas indicate when we were in a recession. And again, here's this mortgage meltdown period. And that is really the only time that home values went down during a recession. And that was because there were foreclosures and some people did short sales or walked away from the properties because of the declining values. And you can see that homes continued to take a dip, but then they have since gone back up and have recovered. And some people would say that they've recovered too well and they've gone too high. But this is just the trend that they've done. And you can see that for the most part, in a recession, home values haven't really been hurt that badly. And so there's also another topic I'd like to talk about is the cost of waiting, because I know that I've had clients where they want to wait either because they want to wait hoping that home prices come down or that interest rates come down a little bit more. And actually, right now, interest rates are at a historic average. If you look over time, around 6% is really a normal rate. It's just that we had dips in the rate during the COVID era that people would like to see those rates again, and it's actually not a healthy rate for our markets. But and home prices coming down, it's hard to say if that's going to happen. I don't think so. They might like slow down, but I don't see any significant drops coming. But I could be wrong. But when home prices do come down, or interest rates come down, what happens is that more people enter the market, and then that helps push rates higher or home prices higher again, excuse me. And that's just because of the pent up demand. So AI helped me with this picture, and it's a little ridiculous. I apologize, but it's not quite this bad. But if a home, is a great looking home and it's priced right, and if rates come down, it just adds to a demand for that home and the potential for a possible bidding war or multiple offers on that home. Another factor to consider is that with the housing shortage that we have going on is because our formations of housing are not keeping up with or excuse me, the completions of housing, the yellow line here, are not keeping up with the formations of new households. And so there's a shortage of homes being added to supply to keep up with the demand. With rates too, of course, there's no guarantee that rates are going down. They have been trending lower lately, which is great. But one thing that you can do, or what I like to let clients know, is that when you buy a home at today's price, you're locking in the price that you buy it at instead of waiting for a lower rate where rates might be higher, and then you're paying more for the same home because of appreciation. And so buying today, you're securing the home at today's price, and you're starting to pay down your mortgage balance. You're getting that appreciation and the tax benefit right away. And then you have the option of refinancing at a later date, meaning redoing your mortgage and getting a lower rate. And so, in fact, I just actually am closing on a client with a lower rate where they bought just a year ago. So it does happen. It's just not a guarantee of when rates will go down. So something that I do is watch the rates for you. And so now we're going to go over some common myths about home buying. And one that comes up a lot in the media is that needing 20% down payment. And you don't have to wait until you have 20% down payment to buy a home. There are so many programs out there that we'll go over later that offer lower down payments, such as FHA, which is as low as 3.5%. VA and USDA loans are 0% down. And conventional loans for first-time home buyers at 3%. And then on top of that, we have down payment assistance programs, so you don't have to wait for the 20% down. One reason why people do want to wait till 20% down is they're trying to avoid PMI or private mortgage insurance at all costs. But it's really a great tool to help you. It's risk-based pricing, so the better your credit and the more your down payment is, the lower the rate for the private mortgage insurance will be. And actually, for first-time home buyers, depending on your income level, you may qualify for reduced private mortgage insurance, but it does help you buy your home now at the price that the home is now. Another myth is that people feeling that they need to wait until they have perfect credit. And A high credit score helps, but it's not a requirement. And so there are loan options for clients with credit scores in the high 500s. So it's worth definitely looking at, seeing what your options are now, seeing if there are improvements that we can make while we wait for your home to become available. But it's best to know these things now by starting the process. Another common myth is that renting is always cheaper than buying. And, it can seem more affordable up front, especially if you do look at a mortgage payment, it might be a little bit higher, but you got to factor in your tax benefits too, or at least consider it. And homeownership does build equity over time where your rental payments will not. And also, when you do your first and last and deposit on a rental property, oftentimes that amount of money might be enough to get you into a home for down payment and closing costs with the down payment assistant minimum down program. Um, some feel that the process is too complicated, and buying a home can feel overwhelming, but with the right mortgage advisor and real estate agent, the process can be broken down step by step, kind of like these classes. And education and preparation makes it much better, so you're taking the right steps by being here. Another myth is that people should wait until they're settled down with their life before they buy. And, whether that means that they're married and having kids, or whatever being settled down means to you. But the truth is, in my opinion, buying is about your financial readiness and goals, not your marital or family status. So, and your lifestyle changes over time. And so you can always buy another home or sell your home. It's really all about what you want and what you want with your financial goals. Student loans have been coming up a lot lately, and there's been so much change with student loans as far as if they're deferred or not deferred. And a student loan debt doesn't automatically disqualify you. Lenders have programs where they do factor in debt to income ratios, and there's different ways that that's done depending on what program we're using. And if you do have a student loan, though, I highly recommend that you check it out to see what status it is in. I've recently had clients that thought that they were deferred and they were not. So do check that out just for your own benefit. And you might want to like pull a credit report, or I can help you with that too. And then the need to find the perfect home. That can really take a while. And I would suggest that first homes are often stepping stones and not your forever home. Buying something that meets your current needs and budget is often, I think, the smartest move. And your first home will probably be somebody else's first home when you're ready to buy your next home. So I think it's so important just to find a good first home and buy it, if it works for you. So how much do you think for down payment, and what do you think your credit scores would need to be for these programs? I've kind of given you some clues in the class so far, but so conventional financing, 3% is the minimum down payment, and that is of the sales price is what this is based off of, with a mid credit score of 620. So it just needs to be 620 or higher. FHA is 3.5% at 580 for credit score. VA is zero down payment with a 620 credit score, and I believe we can go lower with VA too, actually. And a jumbo mortgage, which is a very large loan amount, over $1 million for 2025, is a 10% down payment with a 640 credit score. So the higher the credit score, the better, and we will get into credit scoring on our next class. But really, it doesn't take a huge high level bar to become a homeowner. There are also down payment assistance programs that help with the down payment figures that you see here. And we're going to go over these steps in our future class too, but there is a process that should be followed to have a successful home buying experience. And so before you start shopping for a home actively, I highly recommend that you contact a mortgage professional to start the pre-approval process. And this will help you know how much home you can afford, what the price range is that you can be looking at, or if there's steps that we need to take before you start looking at a home so you can be in a better position to buy. I highly encourage that you have a discovery call. Not all lenders do this, but it'll help identify what your goals are so we can be in sync during your home buying journey. And so these are the upcoming Wednesday workshops that we have. The next one is going to be on October 15th, same time at noon, and we'll be going over credit in depth. And then these are the future ones. I also have a reverse mortgage class coming up on the 22nd, I believe, which is not part of this series, but I just thought I'd mention it because it is a class that I'll be teaching as well. And I'll be sending you a link to the workshop dashboard, which is going to look like this. It'll be updated with the recording of each class that we have. Each module here will be a class that is completed. And when you click on that, it will open up to a screen that will also have your homework and any supporting documents. If your real estate agent referred you to this class, please let me know so I can be sure to thank them. And so just to recap what we've gone over with this class, we have talked about rent versus buying, some home buying myths, and if it's a good time to buy or not. And we've covered a lot for our first workshop. And bottom line, if you're thinking about buying a home, then I think you're ready to take the next steps, even if your home purchase is months away. And you are allowing yourself to learn, prepare for home buying, and get yourself in the best position for when your home becomes available. And I think it's great that you are here today. And so for your homework for this class, I'd like you to check out your workbook that I'll be sending to you afterwards and complete the All About You form. This just helps me get to know you a little bit better and what your goals are. Of course, it's all optional. And then also email me your top 3 reasons for why you'd like to buy a home. Do we have any questions? Thank you, Kim. All right. Well, if you don't have to wait for 2 weeks, if you do want to talk more about home buying, we can talk anytime. Call or text me or email me or scan this code to schedule a discovery call. I am always happy to help you or anyone you know about your home buying needs. And I hope you have the great rest of your week. And I look forward to talking to you soon. Take care. Have a good day. Bye-bye.